So you've heard the terms stocks and bonds, or similar terms like equity and debt, but still have no idea what they mean. Well, let's see if we can clear this up a little. To relate these concepts to everyday life, we're going to look at this in the context of a house, which is very similar to a business, as you'll see. Let's start by first defining equity and debt. Equity reflects an investor or buyer's ownership in a house or business, and debt is when an investor or buyer can borrow from a lender to help fund the purchase of a house or business. The key difference between funding the purchase of a house versus a business is the number of lenders and investors involved. Let's jump in. Let's start with a house, which is actually a business in disguise. Let's imagine we're going to buy a house and rent it out. Voila! The house is now a business. To buy a typical house, we're going to borrow some of the money from a lender to pay for the house with a mortgage, usually for about 80% of the purchase price. We'll then fund the remainder with a down payment. That down payment reflects our ownership, aka equity, in the property. If we were to buy a business, it would be nearly the same thing. Because businesses are typically less predictable though, a lender would likely offer at most 50% of the purchase price. We would similarly have to fund the remainder of the purchase price, which we will call an equity contribution. After the purchase, with the house, we collect payments from renters. With the business, we are paid by our customers. These payments accrue to the owners and increase equity value over time. As you can see here, a rented house is the same as a business. The big difference between a house and a business is that a house usually has one owner and one lender. Business lending and ownership is slightly different. With businesses, we typically have many lenders which offer debt in the form of a bond. As a side note, businesses can also have loans as well, which we'll elaborate on in a future video. From the company's perspective, even though there are many lenders, the debt is viewed as a single unit of debt in aggregate. Similarly, business ownership, aka equity, is typically divided into equal units, called shares of ownership, aka stock. In aggregate though, all of the shareholders are collectively the owners of the business. One of the main reasons for dividing ownership into multiple units is that it makes ownership more affordable for the average investor, without requiring them to buy the whole business. Let's see how this works. If a company wants to raise debt, a common option is to raise debt in the form of bonds. The money typically comes from large, aka institutional lenders, who provide money in return for interest and a promise to repay principal down the road. The lenders here are collectively referred to as bondholders. Once the money has been lent, the bonds are typically traded in the credit market. Whether privately held or publicly traded, most companies have many owners. Each owner, aka shareholder, is entitled to their proportional percentage of profit distributions, or dividends. If a company wants its ownership to be easily sellable, i.e. liquid, then it can list its shares on the stock market for investors to buy. After bonds or stocks are publicly listed, large investors like mutual funds and hedge funds, as well as individual, aka retail investors, can buy and sell both bonds and stocks on a daily basis. Circling back to the beginning of the video, both houses and businesses can be purchased with equity or debt. But the big difference with businesses is that we divide equity into smaller units, or shares of stock, and also divide debt into smaller units called bonds, so they're cheaper to purchase and can be traded among many investors. Hopefully the terms bond and stock, as well as debt and equity, make a little more sense now.